again, if AI is a real thing, then anything that goes into data centers commodity-wise should benefit. Um, but again, you're not seeing that, right? I mean, you
Yeah.
have these blips, and then it doesn't happen. And the narrative, a month and a half, 2 months ago was, well, the utility sector is outperforming because of the sudden realization that you're going to use all this electricity, which is an argument I myself make, like I just did now, and have made in the past. But then, well, utilities have underperformed dramatically the last 3 weeks. What happened to that argument? It went away. It goes back to the skepticism, right? As far as how to think about markets. So we'll see. There has been a lot of money made. I do think it's a very selective mania. If it's real, there's a ton of opportunity out there.
Mr. Michael Gayet, thank you so much for coming on the show, my friend.
Yeah, appreciate the invite.
So, Michael, for people who may not know who you are you? Give us a little bit of a background on your investment journey. What got you into this space?
Yeah, appreciate it. I kind of grew up in the industry, some family history as far as my father having his own investment firm, having a hedge fund where he had guys like Stanley Druckenmiller as clients. He passed in 2008. I reinvented my career and my path in life, found my way to an RIA, did a whole bunch of writing, started getting in the media, launched a mutual fund, had a really good year in 2020 because my whole approach is predicated on the idea of positioning in advance of extreme market events, volatility conditions, favoring accidents, and have two ETFs. I also publish a premium research service called the Lead Lag Report, and I do a lot of work with financial advisors. So I touch a lot of interesting parts of the industry, and thankfully I have a fairly large social media following across Twitter, YouTube, Instagram. I hate the term finfluencer, like financial influencer, because I don't even know what that really means.
First time hearing it. And
Yeah,
I hate it too.
Yeah, I don't like it whatsoever. But I put a lot of content out there that I think hopefully gets people to think differently. I have a certain way of communicating it depending upon the platform I'm on. But the key thing for me is trying to inject a dose of skepticism.
Right. And so let's dig a little deeper on that. Skepticism in which way?
Well, I think that in general, narrative follows price. And
right.
I'm very hesitant on the idea that price is truth, because if that were the case, truth is changing every day, right? Because price is changing every day. We live, I think, in a world where everyone tends to gravitate very quickly to the same line of thinking, right? Recency bias has never been more prevalent. The availability heuristic has never been more prevalent. And that results in overcrowding much faster than we've ever seen in history of trade ideas. That works until it doesn't, right? Now, I tend to, from my own analysis, I think, be somewhat early in identifying when something is becoming crowded. So that causes me to kind of miss out on some of those gains. But at some point, those gains end up evaporating anyway, more likely than not. So that's where the skepticism comes in. I think a lot of people forget that, whatever profits they have because of what could be a mania, you never know if you're going to actually be able to keep it. So keep that risk management in the back of your mind, which you can only do if you're skeptical.
Yeah. Yeah. Well, let's go ahead and dive right in. What is kind of like your overview of the economy at the moment, like a 75,000 foot view?
I mean, I think it is largely very mixed. I mean, I think it's easy to look at aggregate data and say that things are fine and great, but then when you dig deeper, you look at part-time jobs, you look at government hiring, you look at how people feel about the economy. 3 in 5 think we're in a recession because they're killing themselves, taking on multiple jobs to just pay for basic necessities. People often confuse inflation with growth. And certainly politicians love to conflate the two because you see GDP at a certain number, but it may be more because the price of everything is rising as opposed to productivity gains or real gains in terms of the growth of the economy. So it's mixed. I don't think it's a healthy economy when a rising tide does not lift all boats. Right. I think that's largely a truism, not just in the economy, but in markets as well. Now, you and I both know that the stock market is not the economy, and vice versa. Although the stock market can have an impact on consumer spending, the wealth effect, which then maybe bleeds into the economy. But look, we're dealing with still a lot of these lags post-COVID. right? Lag of the shutdown, lag of the reopening, lag of the stimulus, lag of the fastest rate hike cycle in history. So things are going to be uneven because each of those individually is a big deal with these lags that take place. And they reverberate over some prolonged period of time. I just don't think it's as rosy as people think. And I will say that most stocks would agree with me because, as I keep referencing, most stocks are still below their 2021 highs.
Yeah, you strip out. I think it's Nvidia, Microsoft, and maybe Alphabet. I can't remember, or Meta or something. There's a Mag 3 involved. If you strip the Mag 3 out of the equation, the economy, the stock market's actually down, right?
Yeah, I guess it depends on the time frame, but I mean, it's largely true that I've called it a concentration bubble, right? Which is a very different kind of bubble in the sense that it looks like it's a bull market from the market cap weighted averages, but it's because, to your point, it's very concentrated in mega cap
Mhm.
names, certain ones that are having outsized returns. In a real healthy bull market, you should see the rising tide lifting all boats. You should see participation by small caps, by mid caps. Now, don't get me wrong, there are plenty of stocks that have, done well, just not to the extent of the Nvidias of the world, the Microsofts of the world, the AI plays. Um, which is curious to me because I keep going back to it doesn't make sense. If AI is real and it's this next industrial revolution, I'm pretty sure all companies benefited during the first industrial revolution, right? Now, and you're not seeing that dynamic with AI. The hope of all these productivity gains that come from AI should translate into the bottom line of the vast majority of companies, and yet the stocks of the vast majority of companies have gone nowhere.
Yeah, do you see this aligning similarly to what we saw with the tech bubble, or is this kind of like a unique period in time that you can't really make direct comparisons to?
It's always different until it isn't, right?
Mhm.
There are certain things that, yes, are very reminiscent, right? So you look at the large cap to small cap ratio, very similar to the lead up to the tech wreck of 2000, 2002. You look at value relative to growth, ratio is basically back to that same level where the tech bubble burst. It's clearly not that manic compared to then because you don't have the PEs of, hundreds and thousands like you had back then. You didn't have people talking about monetization by the number of eyeballs, right? So my point is you don't have the mania valuation and
Mhm.
hope like you have
Right.
where if a company put .com after their company name, they would just surge just because they put .com. Now, having said
Right.
that, the sentiment I think in a very concentrated way probably is very similar, right? And you can see that and Nvidia is really the poster child of this, and I've been dead wrong on Nvidia. I never imagined, I don't think anybody did, they would act like this. I thought it was going to be quite the opposite, because most stocks have not participated, and the general tend to fall to the soldiers.
Right.
If you look at some of these products, like these levered Nvidia funds, you know, it's very clear there's insane speculation that's going on, like insane speculation,
Yeah.
right? Which is no different than the late '90s, early 2000s.
Yeah, all sizzle, no steak, essentially. I mean, I like the point you brought up about AI, that you're not really seeing any of the benefits that you would see, given if it is a fourth industrial revolution. Being a data scientist myself by trade, I have a master's in applied statistics and everything like that. You can pop open a textbook, a statistics textbook from the 1960s and 1970s, and you'll find neural networks and
Yeah.
all this stuff that we call machine learning, AI.
Right.
That was all. I mean, this isn't anything
It's
new
not
and
new.
revolutionary.
Yeah.
But the focus now has been solely on LLMs. And I recently watched an interview with a renowned data scientist. I think he worked at one of these major tech companies, and he was saying, and I tend to agree with him. And he was saying that how this Chat GPT LLM revolution probably sets back overarching AI research by 10 years or so. Because now you've got all this capital just being just being shoved into just building LLMs. And that's just a small subset of what the AI or data science sphere actually is. So
Yeah,
the fact that you're not,
right. No, and I've said that before. I mean, LLMs are not AI.
yeah,
It's correlative wordplay. I mean, that's the reality. It's not clear. I mean, you know this better than I would, obviously, but it's not clear to me that what people think it is AI is anything other than just faster machine learning, to your point,
yeah.
right? With just now the term AI, right?
We just
And
have the machinery now to actually run these models, which we didn't back in the 70s and 80s.
yeah, exactly. And there's a lot of merit to that. That's not to disparage
Mhm.
it, but it's not. I mean, the idea of consciousness and all this stuff when it comes to AI, Again, unless there's something that I just don't know, which is very possible, right? It just seems like it's everyone's mischaracterizing what it is they're actually investing in.
Yeah. So you with this AI play, and also you have these crypto, mining companies as well. It's just taking up tons of energy.
Yeah.
Um, the data centers, the cryptocurrencies. Uh, would we start to see any? Could we foreseeably see like base metals like nickel, copper, industrial metals like silver become an AI play? Do you think?
Yeah, maybe. I think the longer term argument is around electrification, right? I mean,
Mhm.
it's which I would think probably more argues for nuclear. Like you can't really do AI without nuclear as
Right.
sort of I think the
And
real
probably
ultimate.
natural gas as well.
Yeah, yeah. But yeah, as you know, right, the amount of electricity you get from one pellet of nuclear is, many orders of
Yeah.
magnitude than anything else. Um, so yes, I mean you should again, if AI is a real thing, then anything that goes into data centers commodity wise should benefit. Um, but again, you're not seeing that, right? I mean, you
Yeah.
have these blips and then it doesn't happen. And the narrative, a month and a half, 2 months ago was, well, the utility sector is outperforming because of the sudden realization that you're going to use all this electricity, which is an argument I myself make, like I just did now, and have made in the past. But then, well, utilities have underperformed dramatically in the last 3 weeks. What happened to that argument? It went away. It goes back to the skepticism, right? As far
Yeah.
as how to think about markets. So we'll see. I there has been a lot of money made. I do think it's a very selective mania.
Mhm.
If it's real, there's a ton of opportunity out there. Small caps are due for real outperformance. But going back to that point about 2000, 2002, and that bust of the tech wreck, small caps outperform substantially then by simply being down less, while all the large cap players caught down. I still think that's more likely to be what happens in the future.
Yeah. I mean, what do you think of the proposition that the market is probably, souped up to the nth degree because of social media and just connectivity to the internet right now? I mean, no other point in history do you have retail having access to
Yeah.
stocks and all these other things. So, to your point there, when everyone being on one side of the boat, I mean, that's now magnified to an extreme degree. And so, by definition, opportunity can only exist when there's dislocation in price. If everything was fairly priced at all time, there'd be
Right.
no opportunity. So you've
Right.
got to have your greater full, so to speak. Let's go ahead and shift over to gold and silver. What's kind of like your overall take of the gold and silver market? Gold's been kind of consolidating,
Yeah.
as we spoke about before we hit record. Silver's below this $30 range, which had broken out of momentarily, but now it's kind of been slammed back down. What's your view on the precious metals?
I think it's interesting that gold is holding. To your point that it's consolidating. I've said before, gold is sending a warning, right, as it was kind of starting to break out. I think that initial warning was around Japan, that it shifted to possible war between Iran and Israel. It's like you and I are now old enough to remember World War IV or five, whatever it is now, right? That supposedly was about to happen.
When that
Uh,
gold crypto coin went up to 3,000 or something.
yeah, right,
Was that?
overnight, and
Yeah.
everyone was just losing their minds. And I got a lot of engagement, basically outlining how that could result in
Nice.
a reverse carry trade, right, which still hasn't played out. But um, I do think a large part of the gold doing what it's doing is because there is scared money. There's scared money that wants to be long only, that wants to be risk off without shorting, and is nervous about using the dollar short against other currencies because dollars already had a big move currency wise. Is nervous about utilities as a defensive sector because it's still equities, and is nervous really about long duration treasuries still, given government spending and the volatility that we've seen the last 3 years on the long end of the treasury side of things, which is usually your flight to safety preferred pristine asset, except in this duration crash.
Hmm.
So gold, I think, has become sort of the natural sponge for scared money, and I think it's sticky. Now, I think very much gold is likely to continue moving higher. I say that purely because I don't see the same degree of overconfidence in gold like I used to see back in 2010, 2011. I don't see anywhere near the same degree of overconfidence like you see still in the crypto Bitcoin side of things, right? By the retail community, going back to skepticism. Trends persist on skepticism, they die on confidence, right? So there's still a lot of skepticism, I think, when it comes to gold, which is probably why I think there's another leg higher there. Silver is it's unclear to me on silver. I mean, I know a lot of people reference things like gold silver ratios, poor man's gold, all this stuff. Silver is obviously much more of an industrial commodity, um, and less of a risk off play than gold directly. Um, I suspect silver would do well as well as other commodities, so long as China is recovering economically, because they are the biggest, marginal driver of a lot of the commodity demand. Um, Gold could very much just diverge from all the industrial commodity plays and kind of be in a league of its own. So I think if you're going to play anything, you probably want to play gold and have some exposure to the industrial side, but gold is preferred.
Yeah. So do you subscribe to the notion that gold is an inflation hedge, or is it more so a crisis hedge, or neither? I mean, do you have a different kind of view?
No, it's a good question. I am so on Twitter/X and now Threads, which probably is a big reach on. I will, whenever cryptocurrencies and Bitcoin are down big or up big, I'll take a screenshot and I'll say store of value, right, to kind of poke fun of definitions. Store of value can't have tail risk. If it has big up moves or down moves, it has tail risk, which means it can't be a store of value. It's a volatile investment, right? Gold is not a store of value by definition either, because it also has tail risk. Gold is not an inflation hedge either, because look at what happened in the last decade. It's gone nowhere. I mean, only recently made some returns, but right. It's way under inflation, right? Your point about crisis hedge is interesting. I think the one thing that gold and Bitcoin do have in common is that they are, I would argue, both a hedge to counterparty risk, right? Counterparty risk, either from banks or other institutions, right? I mean, that's the whole idea of Bitcoin. It's a distributed ledger. That's the whole idea of gold. You're holding it physically, right? And it's got value from a historical perspective. But no, I don't think it's an inflation hedge. Now, it is interesting because if I have this whole thesis that part of the reason why gold has also been doing well is gold is sniffing out that you have to return to negative real rates.
Right.
Right.
So I have this poll that was done by the World Gold Council, and they basically asked, you may have seen this poll, but it asked central banks what factors influence their decision to hold gold, and the number one factor was no default risk.
Yeah, of course. Yeah. Which is counterparty risk, right?
Yep, exactly. And then number two was performance during times of crisis.
Yep.
And number three was its historical relevance or precedent as 2,000 plus years as money. Right. So pretty much aligns with what you're saying there.
And by the way, historically, it's fact. I mean, gold doesn't really correlate to very much. If you just look at it from a statistical perspective, gold doesn't correlate to much, which is what makes it such a unique alternative. Right? Mm-hmm. That's why it has value. I'd argue just from a path perspective. But gold does act like a flight to safety commodity, which is the crisis point. Just like when you have, which really relies on credit spreads widening. So if we go back to, it's ultimately about counterparty risk, default risk, then that means gold and treasuries are ultimately about credit spreads, right? Money flees into treasuries because the U.S. government's got a printer. Money flees into gold because there's no default risk. But it only does so when there's a perception that default risk is rising, which is credit spreads widening, right? Which is what has not occurred, at least not yet.
Gotcha. So you mentioned the gold silver ratio. Any other ratios you look at? I look at things like the gold to M2 money supply, the gold to the relative to the CPI, gold to the S&P, among other things, because price is just a moving target in a sense. Yeah. The dollar's a moving target, so gold's got to ask the question compared to what. Are there any denominators that you look at specifically? When you look at your ratios for gold or silver or any commodity or any asset.
Yeah, I mean, you're kind of teeing me up there with the lumber to gold
there you go.
Which is it's really no different in concept than copper to gold, right? Copper is about industrial activity. In the case of lumber, it's about housing starts, right? So it's not some magic relationship. It's just lumber is tied to housing starts. It's why lumber has collapsed the last several weeks.
I see.
I do think that, and I apologize for the noise, as you can tell, my gardener is going to be working on lumber near me. Yeah, exactly. What I will say is that I think in general, when you see gold outperforming other commodities, whether it's something tied to housing or something tied to the economic growth side of things, that's when you want to be careful, right? It doesn't have to be against copper. It doesn't have to be against silver. It doesn't have to be against lumber. It's really about, is gold, why would gold be doing well unless there's some anticipation of something bad happening?
Right. So do you mind if I share my screen really quick?
Yeah,
I'd like to show you this copper to gold chart that I'm looking at. Hey guys, quick pause. Have you ever dreamed about seeing any of the cool guests that we get on Capital Cosm or that you see on these other YouTube channels in person? Well, now you can. We can see Rick Rule, Adrian Day, Danielle DiMartino Booth, Dr. Nomi Prinz, Grant Williams, James Rickards, Lobo Tigre, and more. You can do so by joining the Rick Rule Symposium July 7th through the 11th. You can register now. Link to that is down below. And it takes place in Boca Raton, Florida, on a beach resort. You get to meet all the cool people that you've been watching on YouTube, and you get to do it beachside on a resort. What more do you want? If you're interested, link to that is down below, and let's get back to the video. Okay, so you've got the copper to gold ratio here at the top, and I also have the 10-year, the TNX juxtaposed on top of it. So you've got pretty good correlation up until around July of 2022, and it's when you kind of see it break out divergently. And then the bottom chart here is kind of like this is the correlation coefficient chart. So, anytime it's above zero for the audience, of course, anytime it's above zero, it means that there's positive correlation. So when one moves, the other moves in the same direction. But when it's below zero, it's inversely correlated. So when one moves one direction, the other moves the opposite direction. So for the first time in since '05 or so, the correlation has been negative. Is there anything to make of that? Do you think?
Yeah, and you'll see a similar dynamic with lumber to gold also. That has, for whatever it's worth, been my hell, right? Because at least in terms of the strategies I run that have to be in treasuries, that's which is rates, right? That's been the pain point. It happens in history. This has been particularly unusual in the magnitude of that and the length of time. I think the way you would interpret that, though, is that if there's normally a correlation and the correlation is for a moment in time negative or broken, right, would be the sort of way to frame it. The thing you would want to bet on is the correlation reasserting compared to history. Right. Because again, you're always going to have outliers in a data set, right, especially in the small sample. But as long as there's still cause and effect, what's the cause and effect? If copper is doing poorly, industrial activity is slowing down. That means rates should slow down because the demand for money is dropping. If lumber is weak relative to gold, that means housing starts going to drop. What should that mean for the housing market? Slow down, construction jobs, being less, more layoffs. That should mean demand for money is also falling, right? Which means rates falling. So as long as the cause and effect has not changed, then you want to bet on the correlation reasserting to how it was prior to 2022. And I think that is going to happen. But also, I've been saying that for better part of a year now.
Yeah, so one of three things could happen. The copper to gold ratio could spike back up to catch the TNX, or the TNX could drop all the way down, or they could just move in concert with one another. Again.
Yeah, and the divergence can continue. I mean, that's the challenge, right? It's like you don't know when. The only thing you can say with any degree of confidence is every day you're closer to a reassertion of the prior relationship, as long as the cause and effect is still there. But it can certainly keep on diverging still. It's very hard to time this stuff.
So what should be on the radar screen of the retail investor right now? Like, given all the things that are happening around the world, the moving parts, et cetera, what do you think some of the top three or whatever things that they should be aware of?
I think the only question that ultimately matters is, can the stock market rally without tech? Because everything is couched under that question, right? What's been driving the momentum? Large cap tech. What's made large cap outperform small cap? Tech. What's made US outperform developed international? Tech. What's made growth outperform value? Tech. Right? So substantially. So, and admittedly, yes, that's where the earnings have been. It's also where the PE expansion has been, right? So yes, you've got earnings and growth there, but the pace with which those stocks have risen is substantially more than the fundamentals improving. So if the market can rally without tech, the long-awaited broadening out takes place. Small caps end up having a substantial move higher, and you end up having that leadership taking the averages to new highs. If the market can't rally without tech, then you're still in this sort of hellish environment where you can't really beat the S&P 500 other than by taking on leverage or over allocating to tech, which means taking on more risk. I'm more in the latter camp. I think it's hard to see a scenario where suddenly small caps take the leadership role on the upside. because you still have higher for longer rates against companies that have locked in a lot of loans that are going to be refinanced into higher interest rate environment, combined with very low razor thin margins. But who knows, right? I mean, the funny thing about this environment is that people think that it's actually a great environment to make money in. It's actually horrible. Any kind of asset allocator, forget about what I do from a Lee Lagerport fund manager perspective. Any financial advisor, you're a fiduciary. You're managing other people's money. That means you have to have a mix of asset classes in a portfolio. You can't put an 80-year-old grandmother all into SPY. So what do?
Right.
You blend it against bonds. You blend it against international. You blend it against low vol. So you have a mix. The problem with this environment is that the moment you diversify away from the S&P 500, you're not only underperforming, you're dramatically underperforming, which, candidly pisses off those clients of yours as a financial advisor. Why am I not keeping up? Why can't we have more NVIDIA? Who cares if I'm 80 years old? Right? So it's actually really hard to sort of manage expectations and manage risk properly when anything you do in terms of diversification kills you.
Yeah. So what are some of the biggest mistakes you see retail investors make in general?
I think in general, there's things that I'm very much personally against, right? Because I know the data, I know the research, I've done back tests on this stuff. I think you never want to play with options. Now, I know a lot of people use options and love options trading. I say you never want to play with options because you're playing against time, right? You have to, and that's, people underestimate how important that is, and they underestimate how leverage when you're playing against time can result in a risk of ruin. Timing leverage, or rather not timing leverage in terms of going all in and staying levered without having a plan for when to deleverage, also a big mistake, because when it's working, you're leveraging, you're re-leveraging, you're upping the stakes, you're in that momentum trade, it keeps going up, and then you suddenly have a huge amount of leverage that can reverse very quickly and cause you also to have a substantial drawdown. So you have to have rules around when to deleverage. And then the other mistake I think that a lot of retail does is they short, which I am very against. Even when I'm extraordinarily bearish, I'm the first one to say, don't short, even if I'm right. Don't short. It doesn't work. It doesn't work because you have to be spot on your timing. And people forget when you're shorting, your loss is unlimited, right? I mean, if you're long, most
your downside is infinite. Yeah.
Yeah. So why in the world would you want to take that bet? Now, yes, sure. Some people are really good at it, and some people make a killing shorting. Okay, but they make a killing shorting in a very short time frame, pun intended. But then it's not repeatable, and at some point, if they keep on playing that game, it hurts them, right? Now, the point is, if you're going to be retail and you're going to think about investing, trading, think about investing, trading, not speculating. Shorting is speculation, leveraging is speculating, options are speculating. Yes, a lot of wealth is made by speculation, so is a lot of bankruptcy.
Gotcha. Let's go ahead and shift over to the energy markets. The price of oil sitting north of $80 at the moment. Do you see any drastic changes occurring in the price of oil in the short and midterm?
Again, I think it goes back a little bit to if China has, is going to recover economically. Goes back to that as a driver of commodity demand more broadly. Now, I keep going back to, I'm bullish on energy, right? I'm bullish on oil, which is also why I'm bearish on everything else, because I keep going back to this whole thesis around Japan is predicated on oil relative to a depreciating yen, which becomes a real problem for a country that imports all of its oil. So I think there's still a lot of room there, certainly on the stock side from an outperformance perspective. On the commodity end, yeah, you're probably, again, if China is going to recover, you're probably going to see more upward movements. I'd say be careful if you see an upward spike and then a collapse, because typically when that happens, that's more of a recession tell. But yeah, I think in general, it makes sense to play that. I'd rather choose the energy sector over the tech sector here.
Right. So what is China's route to recovery look like at the moment? I know you said a lot hinges on China, but how does China look at the moment?
I think they are trying to take proactive steps to make it more investor friendly. The reality is nobody wants to allocate to China because everyone's afraid that China's going to come in and destroy an entire industry like they did with tutoring a couple of years back, right? And there's all these concerns around, the debt, the implosion on the real estate side, all that is valid. I know a lot of financial advisors refuse to buy into funds that have China in the name of the fund because their mom and pop investors see that and they say, "Why in the world are you putting my money to work in China?" So I think in general it's also underallocated. Economically speaking, it seems to me that you're probably at a low, and I think the markets themselves are sensing that in China after having been abysmal performers. That does not mean that you're suddenly going to have a surge in economic activity from China, right? Because they still are saddled with debt. But at least if you stop the negative growth, that's enough to get some animal spirits back up, I think, in commodities. So it's not an argument that China is just going to suddenly reaccelerate and drive all growth. It's more of an argument that if the hemorrhaging and bleeding is over, there's all kinds of other positive implications conceivably.
And your thesis about Japan, can you go a little bit more deeper on that?
Yeah, I mean, I've been very early slash wrong on that so far. To me, it still looks like it's a slow moving crisis, but it all predicates. It's all on this idea that the yen, as you know, has been been a free fall, and yen divided by dollar, and Japan imports all of its oil. They have a real problem in terms of oil rising because it's denominated in dollars versus what they have to do, which is import it in yen. So oil rises, yen depreciates, oil in yen actually goes up even faster in a country that relies on all that oil for its own energy consumption. Meanwhile, there is so much leverage that has come from Japan because of their interest rate policy for years, where people are borrowing at these incredibly cheap rates in Japan and deploying it in other countries for higher yields, making the differential. If the Bank of Japan can't control the price of oil, they can control the price of oil in yen, which means they try to save the yen from further falling, in turn creating what I think would be a short covering rally in the yen. Now, if that happens, that creates all kinds of deleveraging from all the borrowed money that came from Japan that is being deployed in other parts of the world. So I have this whole thesis around which it's called the reverse carry trade, which has happened historically. It's not like some new concept. It's just you need to have the trigger of the yen appreciating substantially, which I think the Bank of Japan is going to have to force. Now, I've been saying this since August, right? And every time the Bank of Japan intervenes, yen drops further relative to the dollar. There's going to come a point where something's going to have to give. Either the yen is going to really crash, in which case Japan's got a real crisis in oil price and yen, or the Bank of Japan is going to go ultra aggressive to save the yen, in which case it sparks that margin call from this reverse carry trade. It's a scenario, right? I don't know when it happens. I keep thinking it's going to happen sooner than later. It doesn't happen sooner than later, but it does look like we're in this kind of slow-moving currency crisis, given the way the yen has played out. And I think people underestimate how much capital has come from Japan deployed globally, because every other central bank raised rates except them.
Interesting. And on the topic of increased interest rates or changing interest rates, the ECB and the BOC both came out a couple of weeks ago. Cracks in the wall. 25 basis point rate cut. I mean, it's still chump change, but it's a start nonetheless.
Yeah.
The Fed has said that they don't anticipate more than one rate cut by the end of the year. The question is, with this debt overhang, how much longer can they keep rates this high before, as cliche as it sounds, until something breaks? But they do it all the time.
Yeah.
So it might be a little trite, but it is what it is. But so what's your view there? Can the Fed really deliver on its promise, or do you think rates have to stay higher, or are they going to break down lower?
It's an interesting dynamic, because you could argue that what's really there's a lot of interesting metrics that show that inflation basically is back to the 2%, right? But that's because if you take out shelter, right,
Mm-hmm.
which is the biggest component, right, on the housing side. There is an argument which I myself have made, which I think makes some sense. Part of the reason why shelter is still elevated is because you just don't have the inventory, right? Okay, we all know that, and that's because a lot of people have locked in those rates at 3% and have no incentive to move. Okay, so if mortgage rates drop to 5%, that may be enough to unlock some inventory, because the difference between 3% and 5% may not be big enough to cause people to say, I'm going to keep my 3% loan rather than, right? Rather than going so in a perverse way, lowering rates may actually bring inflation down even further. If it's about housing, right, it could kind
Right.
of create this sort of other dynamic where it creates a flood of inventory. Um, so we'll see. You're right. The Fed usually lowers rates after something breaks. Something breaking is just another way of saying credit spreads widening, which is typically why when they do a reversal on rates, the bulk of a stock market drawdown happens afterwards, right? Meaning, everyone thinks the Fed pivot is bullish. It's, more often than not, definitely not bullish, because they're responding to something that's already underway, right?
Yeah.
So I think you're right. The ECB, the Bank of Canada, they're lowering rates. The interest rate cutting cycle has begun, even though the Fed is not the first to do it. They will end up cutting rates, and the initial reaction may be relief until the reality is it sets in that they're lowering rates and doing what they always do, which is they're doing it too late.
Yeah. Well, there's always the unintended consequences of hiking rates too. When you increase the cost of capital, you also put it's a headwind towards supply.
Right.
So,
Right.
mining projects, oil rigs, all these things cost a lot of money. And when you make it harder to finance, you put a bottleneck in supply, and that increases. You get supply side inflation. So we'll see what happens. It's an interesting thought experiment to ponder. Okay. Michael, thank you so much for coming on, man. Any concluding thoughts before we wrap things up?
No, I think the main thing is, I go back to it's good to have a skeptical mindset on these things. Which again doesn't mean that you go cash or short. It just means you have a different mix of asset classes for a possible scenario that plays out. I've used this line many times. I do believe this. When a rising tide does not lift all boats, everybody drowns. So the whole world is cheering a select number of stocks. Most stocks are still trading sideways. It's basically cheering the wealth gap, but from a market cap perspective, right? So now,
Yeah.
so we're in a world where you've got a huge difference between rich and poor, a huge difference between corporations and individual, and then a huge difference between mega cap corporations and small businesses. And that's what people are cheering for. I would encourage people to not cheer for that because that's not healthy long term.
Yeah. Are you fasting now?
I was fasting yesterday. I just had my OMAD, one meal a day, a little bit earlier. So I'm trying my best to keep on that fasting journey. Now it's a lifestyle thing for me. It's easy to do.
Yeah. What was your longest fast?
That's 6.5 days. Basically, no food,
Wow.
just water and black coffee.
Gotcha. Well, hey guys, if you enjoyed this content, be sure to give us a like, subscribe to the channel if you haven't already. 87% of you guys who watch this content are still not subscribed. So let's go ahead and flip that ratio around. Hit that subscribe button. And if you enjoyed the show, write "Go Michael Go" in the comments. Go Michael Go. And if you have any questions or if you agree or disagree, let me know. Interested to get your thoughts there. And with that said, I will catch you in the next episode. Bye, y'all.